Good afternoon, good evening, good morning to all that have joined us. Hello and welcome to Protiviti's webinar on Climate Reporting 2024, Regulatory Changes in APAC and Globally. A practical insight into what MNCs should be doing now. We're so glad that you've been able to join us today and hope you will find this webinar insightful and useful. Before we begin, I'd like to go through a few housekeeping items to ensure smooth flow of this webinar. We are recording today's webinar and it will be available for on-demand viewing following the live event. Today's webinar will include a video presentation. To ensure the best video quality, we recommend that you use Google Chrome or Firefox as your web browser. You can adjust the webinar audio by using the media player, which is located at the bottom of your webinar console. If you are experiencing technical difficulties during the webcast, let us know by submitting questions through the Q&A area of your screen, and we'd be happy to help. We encourage you to submit your questions throughout the webcast. Our speakers will get in touch to answer your questions as and when possible. CPE credits may be available for this webinar. We encourage you to contact your local association. With this, I now take the opportunity to welcome Yasumi Taniguchi, Protiviti's ESG lead for the APAC region.
Thank you, Vignesh. Welcome to our webinar. My name is Yasumi Taniguchi, APAC ESG leader and senior managing director of Protiviti Japan. It is my pleasure to be your guide through today's session. We have We have this agenda to share what is expected in today's regulatory environment and how best to prepare your organization for compliance and excellence in sustainability reporting. Firstly, we will cover the common challenges faced by multinational corporations, NMCs, as they strive to meet diverse reporting requirements across various jurisdictions. We will then review key regulatory challenges shaping the climate reporting landscape. Our expert speakers will cover what MNCs need to know for effective ESG reporting. Lastly, we'll cover what company needs to do now, providing guidance on priorities for organizations looking to stay ahead in their sustainability reporting. Your participation is highly valued throughout this webinar as we ask some polling questions. Please also share your questions in the Q&A box. I'm happy to introduce the three speakers for today's webinar. Our first speaker is Vignesh Kalyanaman from Protiviti Japan. Vignesh has more than 16 years of expertise in internal audit and risk management across diverse global regions, including Asia, Europe, Africa, the Middle East, and Americas. His extensive skill set covers internal audit, ESG compliance, enterprise risk management, automation, and data governance. We'd especially like to express our thanks to Wan-Chan Lo for his presence today as a special guest speaker from Black Sun. Wan-Chan has more than 30 years of experience in corporate governance, reporting, and risk management. He's currently a member of Sustainability Reporting Advisory Committees, SRAC, set up by Singapore Exchange Regulations and Accounting Corporate Regulatory. Finally, we have Ava Lim from Protiviti Singapore. Ava is a senior manager of Protiviti who has over 16 years of expertise. And her background covers external and internal audit and risk management across various industries, which makes her an integral part of this discussion today. First, we'll cover common challenges. To start our discussion, I'd like to introduce the result of the Protiviti 2023 Global Finance Trends Survey. It is a comprehensive study that examines the emerging priorities shaping finance in 2023 and beyond. In this survey, the top priorities for CFOs and finance leaders over the next years are explored. CEO and CFO sees government and regulators worldwide continue to come up with various new requirements related to ESG, cybersecurity, finance reporting, and AI, artificial intelligence, and more. And ESG has been arising as an area of importance for finance organizations over the past few years. It is still eye-opening to find out through this global survey that ESG metrics and measurement becomes the top priorities for the CFO and finance leaders and teams for the next 12 months. It was ranked 14th in the prior survey. The survey found there was little differences in the views among publicly and privately held organizations, even though the public companies must address a greater number of ESG-related regulatory requirements globally. This suggests that lenders, vendors, customers, and investors, shareholders in need of ESG data is pressing on both private and public companies with similar urgency. Let's take a look at the common challenges that MNC face in the ESG reporting. The first one is that they struggle with the evolving ESG regulations and varying jurisdictions' requirements. We'll cover this later. Another challenge lies in collecting consistent ESG data globally. This task is complex due to varying local practice, languages, and legal environments, which greatly affect the consistency and reliability of the data collected. MNCs often find it difficult to accurately calculate a common company's emission across different geographies. And with multiple frameworks and standards for ESG reporting available, choosing which one to follow can cause confusion. Also, communicating ESG issues with diverse stakeholders present another set of challenges. Each stakeholder group may have different expectations. While external reporting of ESG performance is vital, integrating ESG considerations internally into strategic planning process is also a big challenge. In summary, these challenges underlie the need for MNCs to have robust systems for managing ESG risk and opportunity, along with a clear strategy aligning with their business objectives. Let's further look into the challenges of data and climate reporting. We see the data that 95% of S&P 500 companies already voluntarily disclosing their ESG positions. And 76% of decision makers recognize the importance in complying and analyzing ESG data. Yet only 35% believe they can use technology and data very well to make decisions on advancing ESG strategy. Many must confront the complexity of collecting diverse forms of ESG data, from quantifying tangible metrics like water usage, energy consumption, to assessing more abstract dimensions. So the essential question is, with this wealth of information, how can stakeholders trust the validity of reported figures? Trust is built on transparency, consistency, and accuracy. So ESG reporting challenge is not just about having the data. It's about having reliable data. So let's ask the first polling question to you. What is the current stage of your organization's preparedness on ESG reporting? Please select the one which best fits to your organization. Your choice is A, ESG is not on our agenda yet. B, we just got started discussing ESG. C, we have made progress and now report publicly. D, we have reported for multiple years. Please select the one which is close to your situation and click send. We'll wait for a few more seconds. Okay, is everybody ready to see? Let's see how everybody voted. Okay, thank you very much for voting. We now see, we have reported for multiple years. We do have over 30%, and we have made progress and now reported publicly close to 45%, and we just got started, it is over 20%. So many of you already are in the process of reporting this ESG data. Thank you for participating. Now let's take a look at key regulatory changes in each regions. So yeah, Vignesh, could you take us through?
Sure. Yeah, thank you, Taniguchi-san. It was quite interesting to note that close to 45% of the responses showed that organizations are moving in the direction of public ESG reporting. More interesting was of the fact that over 30% of the organizations have been reporting voluntarily, of course, for many years. As organizations move towards ESG reporting, one of the key challenges multinational organizations in specific face is the varying regulations across the geographies that they operate in. We see that each geography and region has started issuing its own regulations. There have been similarities and dissimilarities among these. This challenge resembles the challenges faced by the finance functions in complying with the varying reporting requirements under the various generally accepted accounting principles, if you may recall. Moreover, we see varied levels of acceptance and openness globally towards ESG and climate reporting. As we move into the second half of 2024, we notice that now major regions of the world have issued their ESG climate reporting requirements. The EU was a pioneer and a frontrunner in ESG space, and entities in the EU have been reporting under the NFRD, which is soon expected to transition into the CSRD come 2025. In the US, the Securities and Exchange Commission issued the climate disclosure rules applicable to listed companies. Yes, these rules have been stayed by a court order due to pushback from various bodies, again showing the difference in acceptance of ESG globally. APAC countries and Australia have also started issuing their climate reporting guidances. Australia issued the 2024 Treasury Laws Amendment Bill, which included the sustainability standards this year. Entities in Japan await the issue of the sustainability disclosure standards in 2025. The SSBJ, the Sustainability Standards Board of Japan, recently issued a draft requesting public comments on the standards before it went live after a formal issuance in 2025. Singapore has also been at the forefront in issuing the ESG regulations, this is to be complied with from 2025. Hong Kong will be issuing an updated ESG reporting code with effect from 2025, which follows in line with its existing ESG reporting guide, which also shows that this region is moving ahead as far as ESG reporting is concerned. While the objective of all these regulations remains similar, to report on the ESG performance within an organization, There are differences in the extent of applicability and disclosure needs across each of them. Now let's look at how we can address this challenge and the role of the ISSB, the International Sustainability Standards Board. The ISSB, under the IFRS Foundation, issued its own set of sustainability reporting standards and has embarked on a journey to have common application of these standards across countries and entities for ease of reporting, as well as to aid comparison of reports in line with reporting needs. This is very similar to the role that was played when the IFRS standards were issued, so as to have commonness across the various regulations. In discussion and on its journey, the ISSB, in coordination with IOSCO, which is the International Organization of Securities Commission, endorsed the use of ISSB standards for capital use. 40 plus countries, including those in the G7 and G20, have publicly backed the ISSB standards. The ISSB has also worked with the European Sustainability Standards Board and GRI to issue interoperability guidance notes to bring alignment and assist entities under both these standards. As recently as May 2024, the interoperability of the ECRS provided more guidance in terms of how entities reporting under these two standards can comply with both these standards. This is a welcome move in the direction of alignment of reporting globally. The ISSB is in discussion with the SEC on the interoperability guidance as we speak. All the countries that we're covering in the APAC region in today's discussion have endorsed its applicability of the ISSB standards issued by the IFRS and have aligned their regulations to these standards. This is a welcome move within this region at least, making things easier. As we move on, I'd like to bring out a broad comparison between the standards in the major regions of the world. You would notice that many of these countries have started moving ahead and also started mandating reporting requirements already. Most of the countries have reporting requirements effective from FY 2025 and so on. Yes, in the US, this is currently still on hold and we are awaiting the court decision. The scope of companies covered in most of the countries relate towards listed companies and in some on large non-listed companies. As I mentioned earlier, the APAC countries seem to be aligning their regulations towards the ISSB standards. However, the US SEC climate disclosures and the existing ESRS standards in the EU are not necessarily aligned. Most of the regulations require Scope 1 and Scope 2 emissions under the Greenhouse Gas Protocol to be reported. They also require the Scope 3 emissions, which is emissions arising from third parties, to be reported under the as part of the climate reporting, except of course in the US, where this was excluded from the scope. When it comes to materiality, all the regulations except the EU have gone ahead with considering single materiality. Just to enhance, single materiality refers to an approach where only those ESG issues that have a direct financial impact on the company's performance are considered material or relevant. In other words, the approach focuses solely on impacts to the organization rather than the organization's impact on the climate and environment. The EU mandated the use of double materiality, and Hong Kong provides it on a voluntary basis and considers both these effects of an organization on the climate as well as the potential impact on these factors on its financial performance. Penalties, of course, seem to be country specific. In certain countries, it is explicitly mentioned, whereas others, it is still not explicitly mentioned. I now hand it over to Eva to take you through the regulations in some of the APAC countries. Eva?
All right. Thanks, Vignesh. Right. So for APAC, we can see that climate reporting is now mandatory across Hong Kong, Australia, and Singapore. Although Japan is currently voluntary, it is expected to become mandatory once the final sustainability disclosure standards are issued in 2025. So in terms of in-scope companies, it is generally applicable to listed companies across Japan, Hong Kong, Australia, and Singapore, with the scope expanded to include non-listed large companies of a certain revenue and, of course, an asset size for Australia and Singapore. Specifically for Singapore, a review will be done in 2027 to consider expanding the scope of reporting to other non-listed large companies by FY 2030. So likewise, as Vignesh has mentioned earlier, if you look at the effective period, this is coming up in the immediate horizon, which is in the fiscal year of 2025. As for Australia, the implementation of reporting requirements is progressive over the next 6 years, with large organizations required to move faster. As to IFRS S1 and S2 adoption on application of ISSB standards, as Vignesh shared earlier on the ESG landscape, the sustainability standards, which specifically S2, is mostly either adopted or made reference in the APAC region, again, namely in Japan, Hong Kong, Australia, and Singapore. And this standard makes sense because it follows the building blocks of TCFD and is also focused on enterprise value, meaning that companies will be asked to disclose how environmental and social factors contribute to or erode a company's total value. In terms of Scope 1 and Scope 2, these are minimum metrics to be reported across the 4 countries, with Scope 3 required for Japan, Hong Kong, Australia, and Singapore. So although for Singapore, it's a little bit unique in the sense that there is a temporary transition relief in the ISSB standards that is extended to non-listed large companies who do not need to report on Scope 3 emissions until further notice from the Sustainability Reporting Advisory Committee. Yes, so on double and single materiality, for Hong Kong, the listing rule do not prevent the board from applying a financial materiality assessment as required under the ISSB standards in determining disclosure of a climate-related risk or opportunity. Although, for the purpose of the new climate requirements, single materiality would be the basis, but issuers are allowed to incorporate double materiality in their ESG reporting if they choose to do so. Under scope of assurance, with exception to Hong Kong, we can observe that there is an increasing focus on the reliance of reported ESG data through the requirement of obtaining limited assurance, which emphasizes even more on the importance of ensuring the auditability of the ESG metrics. Last but not least, on the penalties specific to Australia and Singapore, it would be on the director's accountability or director's duties, which, depending on the nature and extent of the misconduct, it may include fines, disqualification from serving as a director, or imprisonment in cases of severe violations. As for Hong Kong, it would be a general breach of listing rules, and to deter the breach of listing rule under the revised enforcement policy statement, there are sanctions in which the listing committee can impose, which includes but not limited to, for example, public reputational sanctions in a sense of public statement of criticism or public censure, and may also direct remedial actions to be undertaken by the company. For example, an internal control review, the appointment of a compliance advisor, or have the directors go through training on regulatory and legal topics, including listing rule compliance. Right. So with that, it sums up the regulatory updates in the US, Europe, and APAC. And on that note, I will hand over the next section on what MNCs need to know for effective ESG reporting and preparing for external assurance to Taniguchi-san and Wan-Chun. Taniguchi-san. Sorry, Taniguchi-san, I think you're on mute.
Sorry about that. Can you hear me now? Sorry. Okay. While many companies are aware that they must act, they find it difficult to strategically tackle as multinational companies if you actually see the common challenges I just went over earlier. You see this Protiviti's framework. At Protiviti, we view sustainability as an ongoing journey filled with its own set of risks and opportunities. There's no out-of-the-box solutions, and each company needs an individualized approach to ESG reporting and operations. In order to manage this high complexity and position your organization for continued long-term success, a holistic approach is essential. The outer circle of a framework on this slide shows the key challenges, risks, and opportunity found in each environment, social, and governance area, what we refer as meta topics. And you see the impact of sustainability issue on your organization as outside-in impact, and the impact of the company on the people and the planet is referred to as inside-out impacts. With this understanding in place, you can start addressing the identified key areas. When embarking your ESG journey, you should focus on 6 critical components of ESG program that are integral when addressing sustainability. The 6 critical components of ESG program are listed here: strategy and planning, stakeholder engagement, data management and tool, sustainability operation, performance and reporting, governance, risk, and compliance. And their related key activities are listed here. Focus of today's webinar is materiality assessment in the strategy and planning area, and also internal control system and internal audit and assurance and readiness in governance, risk, and compliance, as many of the participants may have some roles in these areas. So Wan Chang will cover what we need to know about the material assessment, and Eva will follow to cover the internal control. So let's hear from Wan Chang of Black Sun Global. Wan Chang.
Thanks very much, Taniguchi-san. What I'm going to do over the next few slides, there's not many slides that I'm covering, but essentially it's really to have that common language, a common risk language that will harmonize materiality assessment and enterprise risk management. And as you go along, just remember it's all about harmonization, a common risk language. Just a little bit about Black Sun. Black Sun is a stakeholder engagement organization. We help companies engage with their stakeholders. As simple as that. Let me point to you a research that was done by the National University of Singapore on governance and sustainability. And one of the gaps, if you look at the right-hand side of this diagram, you can see that there's a gap between materiality assessment processes and for sustainability reasons for the overall organization. So overall organization is for enterprise risk management, and the materiality assessment is for sustainability risk. So here, once again, you have this dichotomy of 2 separate risk language that addresses different things, but should be harmonized. And one of the most telling example of this lack of harmony between the 2 risk languages are the heat maps. If you look at annual reports or sustainability reports, you will see 2 types of heat maps. One is the materiality assessment heat map, which you see on the left-hand side. And on the right-hand side, you see the enterprise risk management heat map. So both are called heat maps. Of course, on the left, sometimes they call it the materiality matrix. But essentially, there are 2 dimensions for each of these heat maps. But the 2 dimensions are different. If you look at enterprise risk management, the dimensions are impact and likelihood, whereas for the dimension for materiality matrix is importance to stakeholders and importance to the organization. But how do you add these two matrices together to have that common risk language? And this is the ultimate challenge, to harmonize these two diagrams that you have quite commonly seen in reports, both annual reports and sustainability reports, and harmonize them and bring them together into one heat map. It doesn't matter what it's called, but it's important because if you look at the sustainability standards, S1, S2, and if you look at COSO enterprise risk management, it's all about risk-based. So it's important to bring it all together to have that common risk language. So one of the first items that I need to look at is to harmonize these two heat maps is that one is quantitative, one is qualitative. So enterprise risk management tend to be a bit more quantitative, and the materiality matrix tend to be more qualitative. And this points to the type of data that's available. If you look at sustainability data, a lot of it is difficult to count. Like, for example, how do you count loyalty? How do you count engagement? How do you add it up together? So that's one of the common elements that's going to be difficult to harmonize. And probably more research needs to be done in order to harmonize data availability and quality for sustainability data, and how does that link to enterprise risk management data? So how do you add the uncountable and the countable together into a harmonized heat map that brings the two types of heat maps together? Of course, the approaches are very different. For enterprise risk management, it tend to be more internal, and the sustainability materiality assessment tends to be more external oriented, external stakeholders. So different dimensions, different engagement, both internal and external. Data is both qualitative and quantitative. So you have three main differences between the two risk management processes, both sustainability and enterprise risk management. If you look at the definition of enterprise risk management and materiality assessment, and materiality assessment, you can see it quite prominent in a lot of regulations around the world. That, for example, EVA presented across the region, across Europe and in the US. So materiality assessment is very commonplace, but people have forgotten about enterprise risk management, which has been around for the last 20 to 30 years. And it's a very mature concept, enterprise risk management. So there are commonalities if you look at the definition. But how do you bring these two together? Once again, it's really bringing the different risk language into a common risk language. That's the key challenge that is, I think, there's an oversight in many organizations. They're going to have these two siloed approach to risk management. So materiality assessment, our proposition is that it can be part of enterprise risk management. So I see many organizations merging sustainability and enterprise risk management function into one function together because both have commonalities. So typically you see ERM as an overarching umbrella over materiality assessments and under other type of risk, like operational risk, for example, or cyber risk. So you have this harmonization of a common language across the organization. And this is a simple diagram as to where it harmonizes. So if you look at the top part of the diagram, you can see materiality assessment, looking at inherent risk and going down to remaining the residual risk. So if you look at that description of risk, it is similar to the description in the ISO 31000, for example, in enterprise risk management. And if you look at the bottom part, risk identification, risk assessment, response, control activities, and monitoring. And you probably realize that it is based on COSO and of course ISO 31000. So materiality assessment fits into the ERM COSO framework of organizations as they adopt enterprise risk management going forward as an overarching umbrella over the organization to have that common risk language. And this is a more detailed example of that harmonization of how materiality assessment fits into the ERM process of the organization. So once again, ERM becomes an overarching risk language for the organization to achieve that harmonization. And this goes into year 2, year 3, year 4. So it's an ongoing continuous basis. I know in many jurisdictions, if you look at the regulations on sustainability, materiality assessment, they don't mandate how often they're to be done. So it doesn't say once a year or twice a year. It's just by practice, tends to be a couple of times once every 2 years kind of time frame for materiality assessment. Whereas for enterprise risk management, typically it's done once a year. So that's another area that needs to be harmonized. Is it going to be 2 years for MA, 1 year for ERM? Is it going to be 1.5 years and once harmonize them, or should it be on an annual basis? So this is something that organizations need to determine so that there's harmonization, not just in terms of the language, but also in terms of practice as to how risk is assessed over a time period of time. So what is year 1, what is year 2? Is it 1.5 years or is it 2 years? So it is really that common alignment for risk teams to learn more about sustainability and for sustainability teams to learn more about risk or ERM. Of course, one of the best practice, I won't say best practice, but an emerging practice is where risk teams and sustainability teams come together as one function. And certainly it's not the end all and be all. There are, of course, other variations, but certainly more research needs to be done as to what that bringing together the teams work mean, and what, if we keep them separate, what does it mean? Because at the top of the organization, you have the risk comm and you have the sustainability comm at the board level. So does that mean that you merge the risk teams and the sustainability teams, you also merge the two comms together, or you don't? And with that, I summarized it by saying that there's two siloed approaches to risk in organizations currently. Sustainability risk, which is done via materiality assessment. You have enterprise risk management, which is done via COSO and the ISO 31000. So there's got to be a meeting of minds within these two siloed risks to have that common risk language. And our proposition is that ERM becomes the overarching umbrella as to how risk is managed, and the materiality assessment is one of the pillars that fits into that umbrella of enterprise risk management. And hopefully this starts a journey into that, a more cohesive and more seamless way of approaching risk management in sustainability management. And with that, let me pass over to you, to Taniguchi-san.
It's actually to me, Manchan, but thank you. Yes. Yeah. Okay. So in this section, we will cover the relevance and application of COSO, as well as I's role over ESG reporting. So as you can see here, I think as a start, in 2023, COSO issued a supplemental guidance on how to effectively apply COSO ICIF, which is currently applied to financial reporting, to cover sustainability reporting. Yeah, and this was issued in recognition of the pressing need for guidance on setting an ESG framework that would address stakeholders' expectations on businesses which are becoming increasingly demanding, and aside from the ever-changing developments in the ESG regulations as well. So apart from being a widely recognized framework, COSO is applicable because its principles are integrated with ESG reporting standards or frameworks. For example, the Global Reporting Initiative, GRI, SASB, or TCFD, which will enhance the overall quality and credibility of ESG disclosures by the reporters. Right. So overall, COSO is a framework to help organizations develop, implement, and assess the effectiveness of internal controls, control systems, which can be adapted to focus specifically on ESG reporting. And it ensures that non-financial information related to sustainability is therefore reliable and credible as well. As you can see here, under the 5 components, which are the control environment, risk assessment, control activities, information and communication, and also monitoring activities, as illustrated in the slide as well, are also 17 principles that does provide further guidance or points of focus on implementing and evaluating each component effectively. So in terms of applying this to ESG reporting, the adaptation involves establishing in the context of control environment, where the focus is on building a culture that prioritizes sustainability and ethical conduct in environmental and social governance. As for risk assessment, it is on identifying ESG-related risks, such as environmental impact, social responsibility, and governance challenges, of course. In terms of control activities, it provides guidance on controls to manage ESG risks, thereby ensuring compliance with sustainability standards and regulations. As for information and communication, it will help to ensure that ESG data is accurately captured and reported, providing transparency and, of course, accountability in that sense. And last but not least, on monitoring activities, it encourages regular reviewing of ESG controls and processes to make sure that this remain effective and aligned with organizational goals. Sorry. So in summary, and also tying back to the ESG program that Taniguchi-san mentioned earlier, which includes the identification of material sustainability risks as part of the ERM process that was highlighted by Wan Chen. It is therefore essential to use COSO as it provides the framework for internal controls governing the sustainability reporting process, particularly on material ESG topics. On that note, I'll move on to the I's role in ESG. So just to give a bit of context, in the same year that the COSO supplemental guidance was issued, the World Business Council for Sustainable Development, NIIA, issued the guidance, which aims to integrate the ESG factors into the 3 lines model, thereby enhancing the framework's applicability to sustainability and responsible business practices. So of course here, if you refer to the first column under the 3 lines model, the governing body, for example, the Sustainability Committee, the responsibility includes providing the governance structure that effectively strengthens the organization's sustainability governance and management process, overseeing the ESG reporting strategy and stakeholder engagement, and of course, integrating ESG considerations into business operations, decision-making, and performance management. Correspondingly, the actions are to incorporate ESG metrics into its strategic planning and daily operations, training employees on ESG risk and opportunities, and as well as implementing internal controls specific to ESG issues. If you refer to the second column under management's role, the responsibility is to oversee and support the first line in managing ESG risks and ensuring compliance with relevant regulations and standards. As to the action, it is to develop and implement ESG risk management frameworks, monitoring the ESG compliance and performance, as well as provide guidance and support on ESG-related matters. So to the point of this slide on IA's role as the third line, it is to provide independent and objective assurance to the board and management on the robustness of internal controls on ESG information. So responsibility is essentially to oversee and support the first line in managing ESG risks and ensuring compliance with the regulations. As to the actions to undertake, these include incorporating ESG risks in the audit plans, assessing the adequacy of ESG controls and reporting processes, as well as report on ESG assurance findings to the board and management. All right, on that note, that sums up the 3-line model, specifically on the IA's role in ESG reporting. Right. So let's move on to the next section, where we will cover the polls over the topics that we just covered. All right, the first poll is on whether your organization has conducted a materiality assessment. There are 4 options. First, it will be yes. Second option, yes, and we are in the process of refining it. Third option, no, we plan to do it this year. Fourth, we have not performed it, but aim to revisit it. So let's take a minute for everyone to participate in this before we move on to the results. Okay, I see there is a mix of responses. For some of you, it's, you're on track, you're in the process of refining it. That's great. I see that's a very big percentage in terms of getting your ESG journey started. Although there are some of you who have not performed it, but that's okay. It's not too late to start now. Okay, all right. Then I'll move on to the next poll. So our next poll is on whether the roles and responsibilities and internal controls over ESG in your organization are clearly defined. The options likewise include 4 options, which are the first one will be yes, second will be yes, but internal controls require improvement. Third one, yes, but both areas require improvement. Fourth, no, we are in the process of establishing both areas. All right, let's take a quick minute to submit your responses. Okay, we're just giving the participants a bit more time to respond before we show the results. Okay, I see there's about 50% who has responded. I think we have a bit of time to spare, maybe just half a minute more. Okay, all right, let's show the results then. All right, so I see here that a big percentage of the respondents here have clarity over the roles and responsibilities and also the internal controls over ESG, although these require improvement. That's okay, because a lot of companies are also just starting on the ESG reporting. So no worries, there's still ample time to get started today. And for those who have started on the ESG reporting, great job. You are well positioned towards ESG reporting. That's great. Yeah. Okay. All right. So once again, thank you all for your participation on the polls. And on that note, I will hand over to Vignesh and Wanchan to cover on what MNCs need to know now. All right, Vignesh, over to you.
Thank you, Eva. And it was quite interesting to look at the poll results once again. I tend to get the sessions after the poll results. So it's good to know that all of you are moving towards ESG reporting, and it also shows the importance that each organization places on materiality assessment and internal controls when it comes to ESG sustainability reporting. As we move on, we'd like to bring out a roadmap on how we can move ahead as an organization, and how, as an organization, you would be well placed to address the challenges of ESG sustainability reporting. We've heard about the challenges faced by the multinational organizations in ESG reporting. We've also looked at the roles played by key functions within an organization and how ESG rolls into some of these. We also heard about the frameworks that can be utilized for effective governance and management of ESG. Now, how do we blend all of these together? In line with what was presented earlier, we recommend that the focus be done over 6 pillars, as you see on the screen. Strategy and planning. Of course, this strategy and plan drives any business objective. So goes for ESG. It is important that the stakeholders within the organization realize the importance of ESG and build strategies and plans to be ESG ready. Stakeholders and people, it is important that awareness is created among the organization and among stakeholders and employees alike on the need for ESG compliance and reporting. Data management and tools. Data is the new oil. We've heard that enough, and so it goes for ESG as well. Data forms the key critical point for reporting on ESG, and it is important that we are able to source the data, validate the data, and report accurately on ESG, just as in any other reporting. Governance, risk, and compliance. It is important for organizations to consider ESG-related risks and build controls to effectively mitigate these risks and monitor them. There should be a focus for GRC-focused functions within an entity to address these ESG-related risks. Performance and reporting. It's a core part of what we spoke today on ESG sustainability reporting. ESG performance and targets should be set for organizations and managements to follow, report, and monitor. Sustainable operations. It is important for organizations to assess, design, and implement capabilities that improve the operations and make it more sustainable to address the requirements of various regulations across the geographies that they operate in. Overall, we believe that once these focused approach over these 6 pillars are considered, it makes it easier for any organization to build and move ahead in their journey of effective ESG sustainability reporting. I now hand it over to Wanchan to take us through a roadmap on sustainability reporting. Wanchan.
Thanks very much, Vignesh. Yeah, if you look at this roadmap that is on your screen right now, how do you move from a first year, second year, and third year in terms of sustainability reporting? Like I said once again, the important part is really having that common risk language as a first part of implementing your sustainability reporting. So reporting is a process, and the report is the end game of the process. So don't just look at the report, but sustainability reporting means that you're going to bring things together within the organization. So year 1 is really harmonization of risk management. Year 2 is looking at compliance with the standards. And year 3 is really doing it better than year 1 and year 2. And this will give you a simple roadmap as to how you move things forward within the organization. Sounds simple, but it is not easy. Let me assure you, it's definitely not easy. And it's not a siloed approach to this. How can you harmonize risk between 2 silos if you look at it in silos? So it's a roundabout way of going nowhere. So the entire organization must come together. And you must remember in integrated reporting, which is not embedded into the part of the ISSB standards. So IR has not gone away. In fact, IR is embedded within S1 and S2. So this is where the true nature of sustainability reporting, together with integrated reporting and harmonization, brings together the process of sustainability reporting to a useful sustainability report for the organization. Vinesh?
Okay. I'll take over the Q&A session. Yes, now the participants are welcome for any questions that you may have over the webinar today. Please type in your question and send. We already see a few questions, so let's try to answer some questions. The first one we see is, who typically owns the sustainability program in the organization? So Ava, would you like to take this question?
Yep, sure. Taniguchi-san. All right. So on the ownership of program, it varies based on the organization and available resources. However, the executive leadership should oversee sustainability initiatives similar to other strategic initiatives. And in recent years, many organizations have created specific sustainability departments or leadership roles to help oversee the sustainability efforts from an operational and/or reporting perspective. So we also did observe that in certain industries, senior management might assign a responsible department such as environmental, health and safety, which is the EHS, or quality assurance to lead certain aspects of the overall sustainability effort. So in summary, a sustainability working group can be established to coordinate the work with related departments. Yeah.
Okay, thanks, Eva. Let's see. the next question. Actually, let's see which one we want to pick. Yeah, let's see. Well, let me ask Ava to take another question. How should management determine which framework or methodology to use? Then maybe I'll ask the next question to Wan Chan.
Sure. Yeah. So the management should determine the framework and methodology based on the organization's regulatory requirements, the industry, the size, and of course, most importantly, the target audience. So actually choosing a framework aligned with the regulatory requirements and industry can help the company address relevant and material issues and ensure compliance. And we did note that many reporting companies actually use more than one standard or framework in their reports. And as we've highlighted earlier, IFRS sustainability standards actually allows companies to cite guidance from other standards or frameworks as long as it doesn't contradict with the prescribed climate-related disclosure requirement. Yep. I hope that answers the question.
Okay, thanks, Eva. And let's ask Wan Chan the next question. The question is, why is materiality assessment important? You already talked about ERM materiality assessment, but why is materiality assessment important? Could you respond to this question?
Sure, Taniguchi-san. Materiality assessment look at sustainability risk, which by itself will comprise of things like climate risk and even operational risk, because it relates to the S part of the organization, and G, of course, you know about G, governance risk. So there's an intertwining of materiality assessment and enterprise risk management. And that's why it's so important to bring it together.
Okay, thank you very much. There's another question maybe Vignesh can take. Where does an organization digitalization process come in for ESG reporting journey, and which areas to focus on first? Vignesh, can you take this question?
Sure, Taniguchi-san. As we discussed, data is the key critical part of an ESG sustainability reporting. And as far as the digitalization process is concerned, it needs to focus on the data source that exists within the organization. We believe that the entire sustainability chain flows across the organization, and it is important that key data sources that are looked at within the entire business value chain of the organization is considered as when you look at ESG reporting. So to answer the question, the digitalization process starts from identifying the key critical data for ESG reporting. Where does this data sit, and is this manual or digitalized? How does this then flow into various systems, and then how does it get reported? So the areas to focus on first would of course depend on the flow of each organization. So that's it. Thank you. I hope this answers the question.
Okay, thanks, Vignesh. And thanks for all participants for questions. And the ones we could not cover today, we will get back to you with responses from the speaker. But I want to express my sincere thanks to all our speakers. As we come to conclude our time together, let us reflect on 3 takeaways. The importance of preparedness, ever-evolving regulatory environment. Let's prepare. Let's start prepared. Let's stay informed and agile, and also be strategic. Tracking ESG challenges require more than reactive measures. So let's call for strategic foresight and individualized approach that aligns with your unique corporate value and goals. And the last one is act now. Hopefully today's discussion have equipped you with actionable insight that can be used as leverage for achieving your target. Thanks to Vignesh, Eva, and our guest Wan Chan from Black Sun. Your expertise has enriched our understanding of evolving landscape of climate reporting regulations, both in APAC and region and globally. I'd like to extend my appreciation to all participants for active involvement. Also, let's continue these important conversations beyond today's webinar. We do have related materials that we will send you after this webinar, the link. And so please stay informed about the future webinars, and also please take a look at all these materials. Thank you once again for joining us today. We look forward to supporting you as you navigate your journey. This will conclude our webinar. Have a nice evening. Thank you very much. Thanks for all speakers and participants.
Thank you.
Thank you, everyone. Have a good one.